Hello, I am Addison Morris with the Women's Cannabis Chamber of Commerce, and this is Cannabis ClipNotes, presented by Angelita Green, the founder and CEO of New Leaf EA. Angelita has over 20 years of experience in accounting and management. She's a certified Dope CFO and has worked with cannabis clients for over 7 years from the seed to sale industries. New Leaf EA specializes in cannabis cash management, Cannabis KPI, Cannabis CFO services, cannabis inventory management, cannabis startup, cannabis tax planning and tax preparation, GAAP, cost accounting and understanding 280E, and tax compliance for all segments of the cannabis industry. So, Angelita, what do entrepreneurs need to know about navigating tax compliance for new cannabis startups?
Hi, Edison, and hello, everybody. I am in my final 4 series of the ClipNotes. If you haven't had a chance to look at the other ones, they should be posted at the Women's Chamber of Commerce website. I have a presentation to give to you, so let me get that loaded and up, and I can show you. I think I can. Okay. All right. So here is the presentation. I'm going to go ahead and start. So as Edison said, we're going to discuss the navigating tax compliance for new cannabis startups. And first, I just want to introduce and thank everybody for being here today for this ClipNotes. I think it's just very important for us to discuss the taxes for, cannabis startups. It's very important. The taxes change all the time for businesses. So let's talk about the basics of cannabis taxes. Section 280E impacts all cannabis businesses by restricting deductions beyond cost of goods sold. Properly categorizing expenses can greatly affect your tax liability and overall compliance. Maximizing your deductions that are allowed under 280E through proper cost allocations or reevaluating your business structures will help mitigate your tax burden. Under 280E, businesses can only deduct expenses that directly relate to cost of goods sold. For instance, cultivation and manufacturing expenses such as raw materials, seeds, nutrients, and labor involved in directly producing the product are typically allowed deductions. On the other hand, indirect expenses like office supplies, advertising, or salaries for administrative roles are disallowed. So considered a cannabis retailer. Costs incurred while purchasing wholesale inventory may qualify as permissible deductions, but payroll for customer service staff working at a retail location would not. A discussion around this topic could include steps businesses could take to clearly document expenses and categorize them correctly to avoid errors and potentially IRS scrutiny. I don't know what I missed there. So there's differences between federal and state requirements. So for state tax reporting, it varies wildly. Some states, such as California and Colorado, allow additional deductions typically not permitted under federal law. This could include operating expenses when calculating state tax liability. Usually that's decoupling. There's several states that allow decoupling. States may impose additional excise taxes specific to cannabis that do not align with federal tax frameworks, requiring separate accounting and documentation. Businesses must identify and adhere to state-specific tax codes, which may include unique categories for cannabis excise taxes, cultivation taxes, or retail state taxes, sales taxes. Some states require more frequent tax reporting, such as monthly instead of quarterly filing taxes, compared to federal deadlines. Properly tracking transactions and compliance with state-mandated seed-to-sale systems is essential for ensuring accurate tax calculations and avoiding potential penalties. Businesses should monitor changes in state tax laws and stay proactive in updating processes to meet evolving requirements. Your outcomes would be avoid mismatched federal and state filings, which could trigger audits. You'll maintain credibility with state regulators by demonstrating precise adherence to their unique tax laws. You'll ensure compliance and accurate segregation of state-specific expenses versus federally deductible costs. So cannabis businesses face numerous tax challenges, including failing to comply with Section 280E, underreporting income, or incorrectly categorizing expenses. These missteps can result in audits, penalties, or long-term financial losses. Common pitfalls include failing to segregate deductible costs from non-deductible ones, mismanaging cash-heavy operations, or neglecting to implement adequate tracking system for transactions and inventory. So what are consequences of improper compliance? A state or federal audit could uncover discrepancies that lead to substantial fines and interest charges, as well as reputational damage that hurts businesses' operations. Beyond the immediate financial impact, repeated noncompliance can draw ongoing scrutiny from regulatory bodies, limiting growth opportunities and damaging relationships with stakeholders. How can you mitigate the risk? Businesses should adopt robust record-keeping practices and hire tax professionals with expertise in cannabis law. Leveraging detailed accounting systems and seed-to-sale software can ensure accuracy and transparency across all financial records. Additionally, conducting regular internal audits staying informed about evolving tax regulations will enable businesses to proactively address any issues before they escalate. By maintaining clear and accurate filings, cannabis businesses can safeguard their operations and achieve long-term regulatory compliance. Filing Form 8300 correctly. Businesses are required to file 8300 whenever they receive $10,000 in cash from a single transaction or related transactions. This form must be filed within 15 days of receiving the cash to remain compliant with IRS regulations. Examples of related transactions include multiple payments from the same customer that collectively exceeded $10,000 within a short time frame. So to comply, businesses must collect key details from the customer, such as their name, their address, taxpayer identification number, and a description of the transaction. Proper documentation is essential and should include receipts, contracts, and any supporting paperwork tied to the transactions. These records must be organized and securely stored for a minimum of 5 years to meet IRS requirements. Accurate and timely filing combined with thorough record-keeping practices is critical to avoid penalties and ensure compliance with federal regulations. These forms do get audited by IRS and sometimes the state. So red flags and how to avoid them. Audits can often be triggered by red flags such as inconsistent reporting between your federal and your state filings or incomplete records. Poor record keeping is one of the most common triggers for an audit, as it creates gaps that may draw unwanted attention from regulators. Discrepancies in reported income, expenses, or other financial details between federal and state filings can also raise suspicion and lead to further scrutiny. To reduce the likelihood of audits, cannabis businesses must prioritize detailed, accurate financial record keeping. Every transaction, contract, and piece of supporting documentation should be recorded and securely stored. Accurate reconciliation of amounts on a regular basis ensures that the financial flow align, minimizing the risk of reporting errors. Additionally, businesses should implement a robust compliance program to address differences in federal and state requirements, ensuring that filings are consistent across all levels. Proactive transparency is your strongest safeguard against potential issues. Developing clear internal processes for data entry, employing reliable accounting software, and seeking periodic professional reviews of your financial records can go a long way in preventing red flags. By adhering to these best practices, businesses can mitigate risk and maintain a reputation of integrity and compliance with stringent regulations. So being audited isn't the end of the road. It's an opportunity to demonstrate your commitment to compliance. If faced with an audit, engage a tax professional immediately and begin organizing all relevant records for the specific time period. Meticulous preparation and expert guidance can streamline the audit process and help resolve any issues effectively. So if you get an audit letter, you want to make sure you hire somebody. You don't have to start talking to them. That way the professional can talk to the auditor. So here is a checklist to stay ahead of the tax compliance challenges and ensure your business is audit ready all the time. You want to create a documented system for tracking financial transactions. Establish a clear and organized process for recording all income, expenses, and transactions. Utilize reliable accounting software to automate and simplify record keeping. Always back up your financial data to ensure security and accessibility. Review state-by-state tax regulations annually. Stay up to date on changing tax laws and regulations in each state your business operates in. Sign up for their updates via email. Consult with tax professionals familiar with the cannabis industry to ensure your compliance. Document any updates or changes in requirements for future references. Conduct detailed reviews of your financial records to identify and correct any discrepancies. Do it like a quarterly internal audit. Cross-check transactions against receipts, contracts, or other supporting documents. Address errors early to prevent escalation during actual audits. By following these actionable steps, cannabis businesses can proactively manage compliance risks, stay aligned with regulations, and operate with confidence. This is a good way to also just, make sure that your employees are doing good and, not taking anything from you. There was a time when I caught an employee, stealing from their own company. They were handling the payroll. They had a fake payroll, and the company got into a lot of debt because they were paying for that extra payroll, and the employee was actually loaning the company back money to help pay for the payroll tax that they couldn't afford. And so they were covering all that up. So you just have to be diligent in paying attention to your financial records, and what is going on in your business. I guess that's all. So thank you for joining this presentation. By maintaining meticulous financial practices, staying informed about regulatory changes, and conducting regular audits, cannabis businesses can not only meet compliance requirements, but also build a strong foundation for sustainable growth and long-term success.
Now is the time to go back and revisit Angelita's series of Cannabis ClipNotes. Each one of them contains information that you need to know now and not in April. Now is the time to prepare for that. This is information that will keep you in compliance and keep you in business. You can find this series on the Women's Cannabis Chamber of Commerce's website. It's also all four of Angelita's Cannabis Clip Notes are also on our LinkedIn page, Facebook, Instagram, and YouTube. So I encourage you all to start preparing now for April. Have a wonderful rest of your week.
Thank you.